Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights.
All right. So super excited for the guests that we have today. We've got Ryan Borchert. He's a super experienced institutional investor, real estate investor, has deployed over $1 billion in transactions across a multitude of asset classes, transaction types, industries. He's been an entrepreneur, senior operator, and has been in the institutional investment space for over 20 years. He's led all underwriting, finance, and investment management functions. He's got expertise in building businesses, financial analysis, deal origination, transaction execution, corporate real estate valuation, acquisition, financing, essentially doing the entire fund management app, fund admin, fund structuring. So, that's super valuable for our community because we're essentially seeing many managers come in and build a franchise. It's not about just a single vehicle that's kind of been one and done. They're kind of taking those vehicles and those series of vehicles and then eventually building an investment practice, right? Which is essentially building a brand new business. And, when you do things at the deal level, it's done completely differently when you look at it at the fund level, right? So kind of really understanding how the buy side works in concert with the sell side is super important. So, Ryan, thanks for coming on. And I think you're going to be a great mentor for a lot of the emerging fund managers that are going through the Sutton Capital program. Maybe just start a little bit with your entrepreneurial experience. I know you've done some private equity as well. So you've bought and sold businesses. So maybe just give us a couple of quick bullets on that experience, and then maybe some high level things that you learned, launching and scaling a new fund. And then we can kind of go into the model. I think today would be really great for the audience here because we're actually going to go through what it takes to kind of actually build an institutional grade fund, specifically in the real estate space. So maybe just give us a couple quick bullets and then we'll jump right into the model.
Yeah, absolutely. Joel, thanks a lot for having me on the podcast. Great to be here. So my background is I started out as an investment banker at Jefferies and the leveraged finance side. Before moving on to the buy side, where I worked for multiple mid-market private equity firms, all based on the West Coast. In those funds, we were investing out of funds managing about $1.5 billion under AUM. So I did that. So I did the institutional finance side of things for about the first decade of my career. And then I really wanted to move to the operational side. So I joined up with a buddy of mine from high school who was just launching a property management business, worked with him for about a year, helped grow that from 2 to about 30 employees. And then I really wanted to own and operate my own business. So I went out and did my own LBO. Went out and acquired a small summer camp-based business that was running summer camps across multiple locations. And that was really, I thought I knew what it was like to run and operate a business from sitting behind, an Excel spreadsheet my whole career. And that was really baptism of fire, where I really learned that there is a much bigger difference between punching things into an Excel spreadsheet on putting together projections on what a business should do versus actually making it happen in the real world. So I like to call that my MBA, my real world MBA, if you will, because I never went back to business school. Mm-hmm. And so I did that for about 3 years and then successfully exited that business, took some time off, and then came back and joined up with some other guys I grew up with to launch and build a real estate private equity firm. And we grew that to about a couple $100 million of portfolio value up until the time when COVID hit. And then I had some health complications post-COVID. And then since I've been getting my feet back under me, I've been, I launched my own consulting practice, and we're currently working on launching effectively an independent sponsor model where we're looking at doing multiple roll-ups across a couple different verticals.
Mm-hmm.
So that's kind of my background. So the first half of my career was really spent on the institutional finance side, really understanding what buyers are looking for, right? And really understanding what the acquisition criteria would be for the folks that are cutting the check. And then I moved over to the operational side, which again could not have been more different and could not have been a completely different set of skills that I don't think most people that are underwriting business truly understand or truly appreciate.
What advice would you have for fund managers that are starting with 0 assets under management and looking to scale to 100 million? I guess, how do you kind of get the attention of LPs, and then how do you get them over the line? I guess maybe some learnings. Obviously, you don't have to share specific learnings if it's proprietary, but just share some wisdom on, what you learned going through the process of running a fund and deploying capital and raising assets.
Yeah. So first and foremost would be define your buy box, right? Really spend the time to figure out what it is that you're interested in acquiring and what that looks like, and be able to understand how to tell that story to LPs, right? So long gone are the days of, generalist buy-side firms, right? There's too much capital chasing too many deals out there, too much specialization. If you're going to be able to compete, if you're going to be able to attract capital, you need to be able to show why your approach is perhaps not necessarily that much different than everybody else, but is differentiated in some degree, and that you have spent the time to truly understand what it is you're looking to acquire, why, and then what you're going to do with that asset afterwards. So
Sure.
I think what a lot of folks get wrong is they're focused on the deal, right? They're just focused on, where do I find something that's going to transact at a price that I think is reasonable, right? And they forget, okay, now that we've done all this work, we've done all this diligence, we've lined up the financing, we've lined up our LP capital, great, we bought this thing. Now, now in today's market, value creation is everything.
Sure.
And it's not enough to simply use financial engineering, simply apply leverage, right? You have got to have an actionable value add plan. And that goes back into really spending the time up front to flesh out your thesis.
Yeah, that's great. Well, when we, think about like asset management, I mean, I think you have so many different customers, right? You have the potential deals that you're investing into. You have to kind of obviously attract those people to kind of come into the portfolio. And then obviously you're, like you said, offering a buy box. So having people come in and really see that this is the buy box that they should be investing in when they look at all the other buy boxes as well. Right. So I think kind of understanding the true match to your mandate versus kind of like what else is out there, and just making sure that mandate is aligned with the product. So I think you said it pretty well. So awesome, man. Well, excited to kind of run through the model. I'm going to throw this up here, Ryan, and you should be able to control it. And people can actually zoom in, and then we'll have this available later to review. But I'll let you kind of start running through this, and I think you could probably zoom in on your screen, and that'll get zoomed in as needed here. So cool.
Yeah, absolutely. So this model is obviously real estate specific, right? Modeling on the real estate side is fundamental, as I'm sure your students know, is fundamentally different than when you're trying to model on the corporate side. There's way less levers of value creation.
Mm-hmm.
on the real estate side, right? And what you're looking at, you know, if you think about what you're buying a box that's generating a stream of cash flow,
Sure.
right? And that cash flow is being used to determine valuation based off the cash flow, right? That's much different than on the corporate side when you're looking at things and, you know, you're looking at synergies, go-to-market strategy, you know, revenue by service offering, margin by service offering. It's much different. So, with all that being said, what this is meant to what this represents is a fund level real estate model. So, in this particular example, this is for a new construction fund. Right? So, this is not a multifamily asset class. This is not industrial. This is, we're going to go out and we're going to drive value through being able to sell for more than what we can build for on a dollar per square foot basis.
Mm-hmm.
So the way this works is that this is your fund level roll up, right? And in order to properly calculate IRRs, right, and time-based returns, you would normally need to model each individual deal separately, right? And you would then need to model when they come online, and you would have one massive stream of cash flow coming in at different times. But the problem with that is that in this particular example, right, we are assuming that we do 10 projects within this fund, right? If I'm going to then turn around and model 10 different deals, I'm going to have 10 different deal models built into this one model, and it just gets way too hectic, right? It just bogs down. It'll crash your Excel, and it's too much. So the way that I've approached it here is that what we do is that we make the assumption that we're going to take the deal level average. What does an average deal look like of those 10 deals, right? And we're going to model one of those deals, right? And then that's going to give you your ability to put in your inputs, put in your assumptions, generate your returns, right? And then what it does is that it rolls all 10 of those deals up onto your fund level tab. And so you'll see your cash flow coming in from each one of these deals as they go. And then it rolls up to the bottom to be able to give you your returns. So let me walk you through how this model works. So what we're looking at here is that we are, you know, like any good model, you've got your inputs tab. Any sort of input is done in a blue demarked cell, right? I can't stress enough. I'm sure your other instructors have hit on this multiple times, but having good modeling hygiene and following best practices is absolutely critical. It's critical not only in order to allow you to replicate a model quickly, audit it effectively, but it allows somebody else to hop in and quickly follow a model. You got to think about ultimately everything that you're producing that's going to the other side is being judged, right? So I've looked at plenty of models where I've hopped in and things are a mess. They're not organized. You know, you don't have proper blue, black, and green coding, all of that sort of thing. The model, the numbers may be totally correct, but I'm going to instantly discount that model, right? It instantly raises the flag in my mind. So although when you're first getting started, it seems like a complete waste of time, I can't stress enough how much this was beat into us in investment banking, that formatting is everything, because it expresses to the other party that you know what you're talking about. So that being said, you've got your basic assumptions that go into here, right? You set your start and end dates. You put in what your capex assumptions are, right? So on the real estate side, what are we buying, right? First, we're buying land. That's going to trade on $1 per square foot basis. That's going to give me my total land costs. Then we got to figure out, okay, what's our vertical build going to cost, right? How many square feet are we building? How does that break down? Hard costs, soft costs, other, right? And then you see that we've also got a cost overrun contingency. Now, things like this are not put in there just purely because it's good modeling best practice, right? Sure, you want to embed, effectively cushion into your model from an underwriting perspective. But what this does is you have to think about the story that you're telling to your potential LP with everything that you do, right? So when we go to fundraise, we're going to direct the LP's attention to the fact that we've already put in a cost contingency, right? You're trying to think about the questions that you're going to be getting, and then you want to get ahead of those so that when the LP says, well, what about this? Here you go. What about that? Here you go, right? You're almost teeing yourself up softball so that when you have those conversations, you come across as being more prepared and more conservative. So that drives down into what your total capex costs are, right? On the real estate side, we look at everything on an absolute dollar basis, but more importantly, on a dollar per square foot basis, right? And then you layer in what your financing assumptions are, right? So in this particular fund, we're assuming that we've got 2 tranches of debt, right? A revolver that then gets taken out with a more permanent term loan if we were running that sort of project. In this case, we're not. We're assuming we build these things and we immediately sell these things. So we don't have any sort of refinancing. But this is what your debt structure would look like. On the real estate side, more common than on the corporate side, right? You've got things like pre-funded debt service. You're going to have a period of interest only. Hopefully, if you can get that on the market, points, fees, what your amortization is, right? And these are all your inputs to get you going. And then there was the scenario of, well, what if we didn't sell these things? What if we wanted to hold on to them and rent them, right? What would that do to returns? This allows you to put in a basic P&L, put in some basic growth assumptions, and then run 3 different cases, right? So in all of my models, I always run a base case, a downside case, and an upside case, right? So that I can personally go through, flex the model, figure out where it breaks. But again, also to give comfort to LPs that I've thought through everything ahead of time. Then you've got your terms of your sponsor waterfall, right? So in this particular transaction, first time fund, we're actually not charging any AUM fees, right? And then I've got the controls for my waterfall. So I can turn on the various tiers. Obviously, in this particular transaction, your first tier is going to be your return of capital, then your pref, right? We've got a GP catch up, and then we've got a very simple single tier 80-20 split thereafter. Sometimes, I think even more so on the real estate side than on the corporate side, you may see multiple tiers, right? So you may have tier 5, tier 6, so that up into a certain return, right? The split up to say 2 times money, it's 80-20, right? If I get the cover off the ball on a deal, then maybe I've got a second tier where between 2 and 3 times return, it's a 70-30 split, right? And then above 3 times, maybe it's 50-50, something like that. But in this particular transaction, we've just got a single tier. And then I like to run my models with some return sensitivities to understand what are the key impacts of a few drivers. So in this particular model, what we're sensitizing is we're sensitizing your construction cost contingency and your exit price, right? Your exit price is obviously going to have the largest impact on the transaction, but I also want to be able to look at and be able to show LPs, right? What does it look like if we totally miss on our budget? Again, all of this is put in there not only for my benefit, but for the story that I'm telling to LPs. I think that's what folks that are, getting started and putting models together, I think don't spend enough time thinking about is what is the person on the other side looking at, right? Like as someone who's literally had probably looked at 10,000 pitch decks in my career, right? You get so used to looking at decks that you'll flip them in 30 seconds. So the poor sponsor just spent a month putting together what they think is the perfect deck, the perfect model. And that's going to get them everything. You need to remember that the guys on the other side looking at this is probably their 10th deal that they've looked at that day. Right? They're tired, they're exhausted. You need to lead the horse to water. So don't just put a bunch of numbers on a page and assume that the other person is going to understand the takeaway that you want them to take away, right? You need to lead them to water. So even things like, here's a sensitivity table. Highlight in yellow things you want to draw people's eyes attention to. Highlight in red the specific number that you want folks to take away, right? So the numbers highlighted in red are the variable case that we're running up above, right? So this 37% and 1.9 times, that's going to tie to your returns at the top. But I can't stress enough to put yourself in the other person's shoes if you were looking at this for the first time, and don't assume they're going to understand what it is you want them to understand. Same thing when you're building a deck. Draw people's eyes attention exactly to what you want them to do. So anyways, these are your basic inputs. Be able to control the deal level model. You can layer in your individual capex assumptions by category, right? For an internal model, right, you're probably going to have this set up differently to where you want to be able to have a deal screener model that you can bang out in 10, 15 minutes of putting in inputs. You don't want to have to spend 2 hours every time you go to do a model. So maybe you're looking at this as simple as these are your inputs, right? So off the top of my head, I'm going to say, okay, we can buy land for $50 a square foot. Okay, in my mind, hard costs $475 a square foot, $50 in other soft costs, $20 a square foot in other, okay, and then a contingency. That's going to allow me to quickly go through and have a deal screener model, be able to punch in my inputs, be able to screen deals in 10 or 15 minutes. But when you're fundraising, what are LPs most focused on, right? In real estate, how do you lose? That's what you always want to be asking yourself the question. How do you lose on any transaction? Well, one of the easiest ways that you lose in real estate is your construction budget just runs rampant and you completely blow through your budget. So in order to get LPs comfortable, again, this goes back to what story am I telling with my numbers? We went ahead and built this in a way that you can literally layer in your individual capex costs. So, this may be getting down to things like, okay, what are we going to spend on electrical? What are we going to spend on plumbing, right? Whatever categories you're looking at, But again, this is put in there for fundraising as much as accuracy in terms of how you're building things up. So you put in your capex, right? It's got logic built into this to figure out when your capex comes online from a timing perspective. And then that's the only thing that you would change, right? Everything else rolls through automatically. So here's your sources and uses of capital, right? Putting on about 60% leverage, 40% equity. It breaks out your use of funds. There's nothing that shows up on the P&L because in this example, we're not assuming that we rent anything. We're purely assuming that we buy and sell. So that's all zeroed out. And then here's where your cash flows are going to be coming in, which are then going to be driving your returns, right? So you've got nothing down to your NOI level, net operating income. Everything is just on the expense side and below. But in order to calculate returns, you literally need to show every dollar coming in, every dollar coming out, and the timing of that to get your IRR correct. And then this rolls up into your, that's going to roll up into your return waterfall, right? You'll see that at the top of every one of these tabs, I've got my return count, right? Because I want to be able to quickly see if I change something, if I change a variable, what's that going to do, right? So it's on every single tab. Here's one other trick from a modeling perspective. If you're going to have multiple tabs, make sure that your columns line up across every single tab. So column I in this example is always month 1, right? That's going to be the same on any of my monthly tabs, right? Column I, month 1. Therefore, when you're linking, it's much easier to avoid making a mistake. And when you're trying to audit something, you can quickly look across something and say, okay, this is all pulling in from whatever column it is. I know that particular column on every single tab happens to be month 1. So it makes it much easier to audit as well. So here, I always like to show a return summary. So again, I'm leading the horse to water. I don't want to bury this information at the bottom of the tab. I want my LP, when they open it and they're scrolling across tabs like this, to immediately be drawn to, here's how much money I'm going to make. Right? That's what they care about. That's why it's highlighted in yellow, in bold, at the top. Again, it's not enough to just build the model. You have to think about what's the story that the model is telling you. And then here you just layer on what your waterfall is going to look like, right? And here are your tiers, right? So here's your first return of capital, right? So you have to return 100% of every dollar invested before we even start thinking about what's your return on capital going to look like, right? Return of capital, return on capital. And it flows through just like we set up on the inputs tab. Here's your prep that's going to come out first, right? In this particular case, there is a GP catch-up after that. And then your ultimate carry split, which in this particular transaction, we're only assuming a single tier. That schedules out to your equity schedule, and then here's your ultimate returns. Here's your debt schedule, right? This allows you to have your debt be fully functioning. You'll see that here, I like to put in as many. So from a modeling convention perspective, the other thing that's really important is even though some of these formulas may, get pretty long, it's really important to show your math, right? Show your work, just like you were taught in elementary school. Don't create these incredibly long, complicated formulas that you can't audit and that the LP can't audit. And that's the biggest problem that I see with folks these days that are just trying to build all of their models using AI, right? They never learned how to build a model in Excel from scratch themselves. They just plug it into Claude and it spits out their model. Well, the problem is Claude, at least today, models like it's writing computer science code. It doesn't model in the way that folks who have been doing this for the past 20 years think about their model buildup. And so as a result of that, it's incredibly easy to have errors built in these AI models, right? A lot of times your AI model will embed hard codes or directly into a formula. So this might say, if this logic happens, then this times 50%. I'm never going to know that there's a times 50% embedded in that. What if the assumption changes in a month when I go to use this model? What if instead of 50, it's now 40%? I totally forgot that there's 50% embedded in here. There's no way that I would catch that, right? So every step in your math needs to be broken out separately. And any sort of hard code like that, anything that's going to be dragged as an input needs to solely be on the inputs tab in a blue cell in blue font, so you'll remember to change it. And you'll see, I also I'll put in actual text, right? So that I can very easily visually see that we never actually switch off from a revolver, right? Or in this case, here's the construction revolver, and then we pay it off. If we had a refinancing scenario being run in there, you would see that this would switch from when we go from the revolver, you take out your construction debt with a more permanent term loan. This would then say term loan. Again, the reason for having all of this is to convey your message to the other person looking at this model and make it absolutely as easy as possible for them to follow. So that's your debt schedule. And then, you don't often see a balance sheet in a real estate model. This comes from my corporate private equity days. I don't understand how you can make sure that everything is functioning properly if you don't have a balance sheet. So you'll see this is not a typical corporate-based balance sheet. It's incredibly simple, right? All we're having is cash and PP&E effectively, but debt and equity, that's it. So this is really for my benefit to make sure that my model is working correctly. And then, so this all rolls up to, here's your individual deal level returns, right? That's one deal. That one deal is the average of the 10 deals that we are saying we're going to do in this fund. And then what this does is that this then pulls in those cash flows for each deal 10 different times. So you'll see, for example, so here's deal one. Here's deal two, right? We're assuming that there's a 90-day or 120-day time lapse in between each deal as we roll them out. So you'll see that your equity deployment is done 10 different times. And again, this is all linked up to the single deal level model and assumptions. And all it's doing is it's using the timeline assumptions that you put in here to then stagger your cash flows appropriately. So what this allows you to do is you'll notice here that your deal level returns, right, are different than your fund level returns, predominantly on the IRR side. And that is purely because under this way of doing things, this is assuming that in this case, you do one deal, you raise the money, your IRR clock starts day one, you build, you sell, you've now returned 100% of it. So your IRR is going to be higher on the deal level. On the fund level, right, this assumes that you raise the entire $20 million day one. So your IRR clock starts day one. And therefore, and does not end until the end of deal 10. And so because of that, right, obviously your IRR at the fund level is going to be lower than it is at the deal level. But you'll notice that on the ROI side, it's effectively the same. And it's effectively the same, with the only difference being that we didn't quite need $20 million, right? We're only actually deploying 19.626 million across the 10 deals. So there's an extra, call it 375K of capital that was unused. And so because of that, you've got a little deterioration on your part, as opposed to at the deal level where you're using 100% of the capital that you raised. So that is basically how we have built this model up. And for me, it's a much easier workaround than trying to have 10 different models that all link up into a fund level model, or have one model where you've got 10 models in one, which then just gets completely unwieldy and Excel well how hard to take. Questions?
Cool. I guess anybody else have any questions overall about just managing a fund, deploying capital? Let me see, Ryan. What are some things that you should think about when it comes to reporting and fund admin, and obviously delivering reporting to LPs?
Well, that's always the part of the job that nobody likes to do.
Yeah, it's the unsexy part, right?
Yeah, that's the unsexy part. And when you're trying to do the 75 other thousand things that you have going on, doing diligence, making acquisitions, managing your portfolio, dealing with tenant issues, whatever that may be, negotiating leases, trying to execute your value creation plan. The last thing somebody wants to do is have to stop in the middle of all that and be like, man, I got to do my quarterly reporting. Yeah. So, but it's absolutely incredibly important, right? Communication with your LPs is everything. Having been, being an LP myself, I want to know that the person on the other side of the table has my best interest in heart. So you got to do the reporting. The good news is that these days there's a lot of great tools that make that much easier. Mm-hmm. And you can very quickly automate a lot of that so that you can set up your agents. It pulls in your reports, right? Pulls them out of QuickBooks or whatever financial software you're using. You can even set it up so that, you've got your reporting templates. It will populate them automatically. What I would say on reporting is make it as standardized as you can. Do not recreate the wheel every single time, and automate as much as you can, because it's a necessary evil. It's a necessary part of the job, but it's the part of the job nobody likes to do.
Yeah, absolutely. I would say too, when you give people K1s, when you think about things from a tax perspective, that may be different than what you're seeing on a capital account statement, right? The admin side sometimes is different than actual P&L. So, sometimes you have to treat those differently, I'd assume, in a lot of situations. So sometimes there's paper gains, but then there's actual P&L that you want to think through from a tax standpoint.
Yeah, that's right. And then just like everything else, just remember that you're being judged, right, on everything that you do.
Yeah.
So the details matter. So if you're that fund that doesn't deliver your K1s until, the big end of August, beginning of September, and people are jamming to get their taxes done and they're late because of that, they're assuming that you're not organized.
Yeah.
And so timing matters. Get your reports done on time.
Yeah. What do you, so a couple things. I've changed my opinion on, I think, what some of the most important skills are, like when you just get into asset management. I used to think it was just sales. It's like, hey, you know what? You're good at selling. You need to sell people to join your team and join your staff. You need to sell the portfolio investments that you're investing in to take your money. You have to sell LPs to actually give you money. So you're always selling, and you're selling the vision. You're selling yourself. You're selling a product. But then I've kind of changed that to actually learning things quickly, because I think if you can learn things quickly, it's going to help you sell much faster. And, times change, technology changes, people, processes, infrastructure changes. I've recently tweaked it to responding quickly. So a lot of times if a client needs something from you and you just respond quickly, I feel like that makes a huge difference. So I've kind of just went back and forth on, I think, what, super important skills are in the investment management space, but we'll love to hear your opinion, also being an LP, when you've kind of looked at managers to allocate to, what do you think has stood out in terms of like the best fund managers and, the things that they've done? And integrity is a huge thing too, which kind of I'd say cascades on top of everything. But in your opinion, what do you think have been those characteristics of like the best fund managers?
I think it's the folks that, it touches on your selling point, but I think it's the folks that can tell the story, right? It's like you need to be able to articulate things concisely. And somebody who takes 5 minutes to explain a 30-second elevator pitch, to me, shows that they don't have a great mastery of the subject in which they're speaking, right? So get good at telling your story. And just remember that every little thing that you do, you're being judged, whether it's consciously or subconsciously. So to your point, reply time makes a huge difference. We all know that person that you work with, who you send them an email at 9 o'clock at night, they'll respond by 9:02, right? Now, I'm not saying you always have to reply at all hours of the night, but we all know that consciously or subconsciously, that person that replies quickly, concisely, you just assume that they're on top of things. And the other thing that I think, the other big point of differentiation that I would just say is show, don't tell, right?
Yeah.
Show me what you're doing. Show me the result, especially in today's world where everything is on video, right? I'm still old enough where it's still weird for me that I can't just pick up the phone and call somebody anymore, right?
Yeah.
I almost have to schedule a call, hop on video. I can't just call yourself. I mean, I can obviously, but that is not what social protocol is anymore. Social protocol is so visually based that think about how to best tell your story. So rather than just putting together a quarterly report that's got numbers and text, put in some pictures, right? One of the better LP fundraising tools that we ever had was one of the warehouses that we completely gutted and redid in our last real estate private equity firm, right? My partner was smart enough to put in a time-lapse camera at the beginning of the project and film the entire thing, right? For 3 months. And so when we put out our quarterly report, we could attach a 2-minute time-lapse video that quickly showed everything that had been done. We had so much positive feedback from LPs.
Sure.
Right? Because they could visually see what was going on. It's not enough to just say, hey, I bought this at $100 a square foot. We put in $300 a square foot, right? And I sold it at $700 a square foot. Wasn't that a great deal? If I can, that's all table stakes. Those are all things you have to do. But show me how you created value. Show me how you're different than anybody else.
Yeah.
Show.
Absolutely. Well, hey, we'll give it 1 or 2 seconds. If anybody has any questions, I'll give it like a second. If you don't, we could reach out. We got your contact info, Ryan. So we'll share that out if people have questions as well. And thanks for your time. Really appreciate it. Really learned a lot. And I think it's always super important for fund managers or emerging fund managers to have a big brother that's already done it, to kind of just, learn from mistakes and learn from successes. That's what the whole ecosystem is all about. So appreciate all you do. And also for the LP ecosystem as well.
Yeah, absolutely. Joel, thanks a lot for having me on the podcast today. And, to the extent that I can be helpful to you or any of your students, please don't hesitate to reach out. It's pretty hard to walk somebody through a model on a screen, on a video. So without really being able to dig in. So if anyone has any follow-up questions after they've had time to go through the model, play with it, dig in, understand why things are the way they are, how it works, don't hesitate to reach out.
Great. Awesome. Well, thanks so much, Ryan. Really appreciate it. And everybody else, have a great day. Take care.
All right. Thanks a lot. Have a great day.
Bye.